I've seen executives defer carefully for a decade and trigger a substantial tax bill in a single year from one default election they made during a 10-minute enrollment process and never revisited. Deferred compensation is one of the most common benefits offered to senior executives at publicly traded companies, and it's one of the pieces executives tend to spend the least amount of time thinking about carefully. Most people enroll, pick a deferral percentage, pick a default distribution option, and move on. The problem is, deferred compensation rewards deliberate planning more than almost anything else in a compensation package, and it doesn't forgive autopilot decisions. In this video, I want to walk through what deferred compensation actually is, how to think about whether it fits your situation, and the decisions most often made without the attention they deserve. I'm Aaron Klemm. I'm the founder of Inflection Point Wealth Management. This is video 6 in our informational series on executive compensation. If this topic is relevant to you, be sure to subscribe so that you see other content that will also apply to you. So far, we've covered restricted stock units, non-qualified stock options, incentive stock options, performance stock units, and employee stock purchase plans. This one is non-qualified deferred compensation, or NQDC. Same framework as always. What is it? Where do executives get it wrong? And how should you think about it in the context of your full plan? Non-qualified deferred compensation is a plan your employer offers that lets you defer a portion of your current income, salary, bonus, or both, into a future year, in exchange for receiving it back at some point in the future. Unlike a 401k, these plans don't have a contribution limit set by the IRS. You can defer a large percentage of your income, 25%, 50%, sometimes more. The money grows on a tax-deferred basis inside the plan, and you pay ordinary income tax rates when distributions are made to you. These plans are governed by IRS Section 409A, which is a rigorous set of rules about when elections can be made, when they can be changed, and when the distributions can happen. And here's how the mechanics work. Every year, usually during open enrollment in the fall, you make two major elections for the following year. First, how much of your salary, bonus, or incentive compensation you're going to defer. Second, when and how you'll receive those deferred amounts back, a specific date, at separation from service, at retirement, and whether it'll come out as a lump sum or installments over a set number of years. Once those elections are made, they are generally irrevocable. You cannot change your deferral rate mid-year. You cannot pull money out early. You can delay a scheduled distribution, but only if you meet the 5-year redeferral rule. The new distribution date has to be at least 5 years later than the original, and the change has to be made at least 12 months before the original distribution date. There's no undo button. The decisions you make in October for the following plan year will cascade through your financial life for years, sometimes decades. Now here's the piece most executives don't fully appreciate. The money in your deferred compensation plan is not technically your money. It's an unsecured promise from your employer to pay you in the future. Most plans use what's called a rabbi trust, which protects the money from the employer changing their mind. They can't just cancel your account, but it does not protect the money from the employer's creditors. If the company files bankruptcy, you are a general unsecured creditor. You get in line with the vendors and the bondholders. In historical cases of large corporate bankruptcies, Enron and Lehman Brothers being the most visible, executives with non-qualified deferred compensation balances lost most or all of it. One more mechanical note on taxation. For federal income taxes, deferred amounts are not taxed until distribution, but for FICA purposes, Social Security and Medicare, the tax is generally paid at the time of deferral, not at the distribution. So the Social Security and Medicare piece is locked up on the front end. The income tax deferral is the piece you're optimizing for. Before we get into where executives go wrong with non-qualified deferred compensation, I want to address the question that should come first. Is this plan the right tool for you in the first place? Non-qualified deferred compensation isn't automatically a good deal. The tax deferral is real, but so is everything sitting around it. The creditor risks, the irrevocability, the opportunity cost of the money. Not every executive should participate, and the ones who should aren't all participating at the same level. Here are the 5 things worth evaluating before you defer $1. First, your company's credit condition. Since your deferred balance is an unsecured obligation of your employer, the financial strength of the company matters. A strong balance sheet, investment-grade credit, a stable industry, the creditor risk is low. A highly leveraged company in a cyclical industry with tight cash flow, the credit risk is real. And it's a factor you have to weigh. And this isn't just about bankruptcy. Restructurings, acquisitions, and liquidity crunches can all change how a plan pays out or whether the company honors the full balance. Second, how far are you from distribution? The longer your deferral, the longer your exposure to the company's credit. Deferring for 3 years is a different risk profile than deferring for 20. A 40-year-old with 20 years to retirement is taking on more cumulative exposure than a 60-year-old whose plan starts distributions in 5 years. If your time horizon is long, the credit condition of your employer matters more. Third, your marginal tax bracket now versus what you expect in retirement. The core economic thesis of non-qualified deferred compensation is tax arbitrage. You defer at a high current rate and pay at a lower rate later. For many executives, retirement brackets do come in lower than working brackets, so the direction is right. The question is, how much lower? Between 401k and IRA balances generating required minimum distributions, a taxable portfolio throwing off dividends and gains, Social Security, a possible pension, and then the non-qualified deferred compensation distributions themselves, retirement income stacks up in a way that often keeps you in an upper brackets longer than simple, I'll be in a lower bracket later assumption suggests. The real question isn't whether your bracket drops, it's by how much and when. If the expected differential is modest, the tax arbitrage alone may not be enough to justify the other trade-offs. Fourth, opportunity cost. Money deferred into non-qualified deferred compensation isn't available for anything else. It's not earning a return in your diversified portfolio. It's not buying real estate. It's not funding a 529 plan for the kids. Before you defer, ask what else this money could do. If the tax benefit of deferring exceeds the opportunity cost, participation makes sense. If it doesn't, the deferral doesn't earn its keep. Fifth, cash flow. Deferrals reduce your take-home pay. If your current expenses, debt payments, and other savings commitments already consume most of your paycheck, a large non-qualified deferral creates pressure somewhere else. Whatever you defer has to be sustainable alongside the rest of your plan. One more piece of context that ties the first two lenses together. These plans tend to work better for executives closer to retirement than those further from it. A shorter time horizon reduces your cumulative credit exposure to the employer, making your retirement income picture easier to forecast. It makes the tax arbitrage easier to predict. For an executive 3 to 7 years from planned distribution, the non-qualified deferred compensation often lands in a sensible place in the plan. For an executive 15 or 20 years out, the uncertainty compounds across every dimension. The company's credit condition over that horizon, your own career path, and what tax rates even look like in the distribution years. The short version, non-qualified deferred compensation tends to work well for executives at credit-strong companies closer to retirement than not, with a meaningful bracket differential between today and their expected retirement years, with a solid cash flow and with a thoughtful distribution plan already in mind. It works less well for executives at leveraged or cyclical companies far from retirement, with retirement income likely to land closer to current income or with competing priorities for the same dollars. Those aren't good or bad categories, they're just different situations. Make sure the juice is worth the squeeze before you lock anything in. Here's the first place executives go wrong. Once enrolled, the easiest mental model to apply is the 401k model. Money goes in, it grows, you get it out when you retire. The problem is, non-qualified deferred compensation is not a 401k, and treating it that way creates two categories of risk. The first is the creditor exposure we just talked about. In a 401k, your balance is held in a trust for your benefit. If the company goes under, your 401k is protected. It's your money, fully separated from the company's balance sheet. In non-qualified deferred compensation, your balance is an unfunded promise from the employer. Same amount of money on paper, completely different risk profile underneath. An executive with significant exposure to company stock through RSUs, PSUs, and options, plus a large non-qualified deferred compensation balance, has concentrated their financial future on a single company in a way that often is much deeper than they realize. The second is the irrevocability. In a 401k, you can adjust your contribution rate at any time. Borrow against the balance, change investments, and at separation, you have a menu of options. Stay in the plan, roll to an IRA, take distributions on your own timing. In a non-qualified deferred compensation plan, the deferral decision is locked in annually, and you cannot roll the balance over at separation. No IRA rollover, no 60-day window. The distribution follows the schedule you elected during your annual enrollment on the plan's terms. The reason this matters practically is that executives who think non-qualified deferred compensation as just another retirement bucket often skip the harder planning work. They enroll, they pick a reasonable deferral rate, they default to a standard distribution election, and they move on. For a 401k, that's fine. For non-qualified deferred compensation, that passivity is where the real costs get built in, which brings up the second pitfall. Here's the second pitfall. The elections decisions you make during each annual enrollment cascade into a tax outcome years or decades later. The plan is not designed to show you what those elections will cost you. That's a projection you have to build yourself, and most executives never do. If you make those elections without projecting what the outcome is likely to look like, you can end up locking in a result you never would have chosen on purpose. This isn't a pitfall you fix after the fact. It's one you avoid through planning done before you click the default option. Here's what the planning actually looks like. Before each annual enrollment, you want a reasonable projection of 4 things. First, what your total non-qualified deferred compensation balance is likely to grow to by the time you separate or retire. Factoring in your expected annual deferrals, the investment return the plan is crediting, and the number of years between now and distribution. Second, the window over which you'd want that balance to come back to you. Lump sum is one option, installments over 5, 10, or 15 years is another. The right answer is the one that spreads the income across tax years in a way that matches the rest of your retirement income plan. Third, the tax arbitrage you actually expect to capture. Your current marginal rate versus what you project for the distribution years, with clear eyes about the fact that retirement brackets for executives aren't always much lower as people assume. Fourth, how the non-qualified deferred compensation distributions will interact with other income sources in those years. None of this is precise, but even rough projections are usually enough to tell you whether the default lump sum at separation election is the right answer for you, or whether the schedule needs to be structured differently. Here's what happens when the projection work doesn't get done. A sample scenario. An executive has been deferring 20% of salary plus bonus for 10 years, call it around $200,000 per year on average. With growth, the balance is around $3 million. During each enrollment, the default distribution option was lump sum at separation from service. That's what got clicked, because it was simple and separation was 10 or 15 years away. Then, the executive separates at 58. The full $3 million becomes taxable at ordinary income in that one tax year, stacked on top of final year salary and bonus. Total single year income north of $3.5 million, essentially all above 37% federal tax brackets. State income tax sits on top of that. Federal tax on non-qualified deferred compensation distributions alone can run north of $1.1 million. The tax arbitrage the executive is trying to build over a decade gets paid back to the IRS at the top marginal rate in a single year. This was entirely avoidable by increasing the quality of their planning and getting to the core of why they were doing what they were doing. The executives who avoid this aren't smarter. They did the projection work before each election. They looked at where the balance was heading, what window made sense to distribute it over, and what their retirement tax picture looked like in that window. Those projections inform the schedule they elected at each annual enrollment, and because non-qualified deferred compensation elections are annual, each year is another opportunity to revisit the projections and adjust the schedule, which means the work is iterative, not one and done. Even the executives who plan their distribution schedule often plan it in isolation. They get the non-qualified deferred compensation spread out over, say, 10 years, problem solved. Then, retirement actually arrives and they realize every other income stream is landing on the same year's tax return. Social Security kicks in at 67, pension benefits start, required minimum distributions from the 401k and IRA begin at 73. The taxable brokerage portfolio is throwing off dividends and capital gains. Each income stream was optimized on its own, but they all stack on the same 1040. The result can be a retirement where the tax years look a lot like the working years. If your non-qualified deferred compensation distributions are $200,000 a year, Social Security is $60,000, your pension is another $100,000, and your RMDs are $150,000 plus investment income, you're at $500,000 plus of taxable income in retirement. That triggers IRMA surcharges on Medicare, the 3.8% net investment income tax on portfolio income, and keeps you in the same top brackets you were trying to escape by deferring in the first place. The fix is coordinating the non-qualified deferred compensation distribution schedule against full retirement income picture, not just in isolation. That usually means front-loading non-qualified deferred compensation distributions into the early retirement years. The gap between when you separate and when Social Security, pension benefits, and RMD start. Those early retirement years, often between 58 and 70, are usually the lowest bracket years in a retirement plan. If you concentrate non-qualified distributions there, you will fill up the lower tax brackets with non-qualified income while your other sources haven't started yet. Then, once the other sources turn on, you're not stacking non-qualified distributions on top of them. This is planning that happens years in advance and requires a full retirement income projection, not just a few of the non-qualified deferred compensation schedule. But when it's done well, it could possibly save 6 or 7 figures of tax across a retirement horizon. When it's not done, the tax savings you are trying to create by deferring often disappear. So how do you actually use non-qualified deferred compensation? Here's the framework. Step 1 is to run the 5-part evaluation before you defer anything. Company credit condition, time to distribution, current versus expected retirement tax brackets, opportunity cost, and cash flow. If the answers don't line up in your favor, participation at all may not be the right call. There is no rule that says executives have to enroll. Step 2 is to size your deferral thoughtfully. Do not max just because you can. The optimal deferral rate is the one that captures meaningful tax arbitrage without over-concentrating your exposure to the company or tying up money that serves other goals better. Step 3 is to plan the distribution schedule each annual enrollment. Every year you defer, make a deliberate election about how and when that year's deferrals will come back to you. Spread across multiple years, target specific dates, use installments. Do not default to lump sum at separation unless you have actively decided that that's the right answer for your situation. Step 4 is to coordinate non-qualified deferred compensation distributions with your full retirement income plan. Social Security timing, RMD start dates, pension elections, and taxable portfolio withdrawals all interact with non-qualified deferred comp plans. The goal is the lowest tax bill across your full retirement horizon, not just the lowest tax bill on the non-qualified deferred compensation. Step 5 is to monitor your company's credit condition. Revisit annually. If your employer's financial position deteriorates materially, the risk profile on your existing deferred balance has changed, and you may want to adjust future elections. Step 6 is to use the 5-year redeferral rule when it helps. If an upcoming distribution is scheduled for a year where it could stack poorly with other income, you can push it out at least 5 more years, but you have to make that election at least 12 months before the original distribution date. This is a planning tool. Use it intentionally, not reactively. Here's the through line on non-qualified deferred compensation. It's one of the most powerful and the riskiest pieces of executive compensation. The tax deferral is real. The control over timing, used well, is real. But the creditor exposure is real. The irrevocability is real. And the opportunity cost is real. Not every executive should participate. And for those who do, the value comes less from the decision to enroll and more from what you do at every annual enrollment afterwards. The deferral amount, the distribution schedule, the coordination with the rest of your retirement plan. This is one of the few pieces of executive compensation where autopilot costs real money. Non-qualified deferred compensation open enrollment typically runs in October and November. The deferral percentage and distribution elections you make during that window are locked in for the following year, and largely irrevocable after that. If you haven't projected what your balance will look like at distribution, or modeled how those distributions will interact with your other retirement income, that work needs to happen before your enrollment closes, not after. This channel is built for high-earning professionals and executives, delivering content on navigating complex financial decisions, equity compensation, tax strategy, retirement planning, and concentrated wealth. If these topics are valuable to you, be sure to subscribe so that you get more free content. Thanks for joining. I'll see you next time.